Every stop loss you have ever had taken out was filled by somebody. Not by the market and not by bad luck, by a trader waiting exactly where your risk was parked. In this video, you will learn the complete smart money concepts model I use to stand on that side of the trade, combining liquidity sweeps, higher time frame bias, precise session timing, and execution through inversion fair value gaps. Step by step, you will see how to identify clean setups, align with market structure, and execute trades with clarity, precision, and consistency. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. To begin, this trading model stands out as one of the most effective approaches you can apply in today's markets. What makes it so reliable is the way it integrates multiple key elements into a single structured system. Higher time frame context, dynamic liquidity delivery, external liquidity sweeps, and precise session timing, all aligned within one cohesive trading plan. When these factors come together, they generate high probability setups capable of consistently delivering premium trades with strong win rates. In a bullish scenario, this setup forms when price sweeps sell-side liquidity from a key level just before tapping into an unmitigated bullish fair value gap. Shortly after, price quickly reverses back inside the range of that level and continues pushing higher with strength. Even so, it is important to understand that not every liquidity sweep at a random moment, combined with a random fair value gap, will result in premium setups. For optimal performance, proper alignment with specific time windows and time frames is essential. Looking at the bearish side, the same principle applies in reverse. Price sweeps buy-side liquidity from a key level at a specific time, taps into an unmitigated bearish fair value gap, and then sharply reverses back inside the range before continuing lower. Even then, for this setup to perform consistently, certain conditions must be satisfied before we explore them further and see exactly how the setup unfolds. Notice what that sweep really is. Traders park their stops where a level looks obvious, because obvious feels safe, and loss aversion clusters the whole crowd within the same few pips. The move against you is the market collecting them. Before moving forward, it is important to understand what truly gives this setup its strength. The real advantage appears when the market sweeps liquidity and mitigates a fair value gap at the same time. Whenever price targets liquidity near a key level, such as a swing high or swing low, while also filling a fair value gap, it removes two major sources of pressure simultaneously. To break it down further, the first source is the liquidity imbalance inside the fair value gap, and the second is the stop losses of early traders who entered prematurely. Once both are cleared, the path becomes significantly cleaner for price to move decisively toward the next liquidity pool. This is precisely what makes the setup so effective in real market conditions. Rather than being just a technical pattern, it is grounded in actual market behavior. Read that second source again, because it is a person. Someone saw the same level, entered before it was confirmed, then defended the position long after the chart stopped agreeing. That is cognitive dissonance, and the exit it forces is your fuel. Moving into execution, we can now break this setup down step by step to understand how to trade it effectively. In a bearish scenario, the first step is to identify a previous session high positioned just below an unmitigated 15-minute fair value gap. As an example, when trading the London session, the focus should be on the Asian session high that forms directly beneath a 15-minute unmitigated fair value gap. Once that is identified, the next step is to wait for London to open and closely observe price action. As soon as price sweeps the liquidity above the Asian high, taps into the 15-minute fair value gap, and then quickly reverses back inside the range, This provides the first layer of confirmation. From there, shifting to a lower time frame, such as the 5-minute or 1-minute chart, allows you to track the higher time frame delivery and identify clear reversal confirmations. This is where most traders lose the setup before it exists. Waiting for one specific hour feels like doing nothing, and doing nothing feels like falling behind, so the trade gets taken early somewhere else. The hour is the setup. At this point, an entry model must be present before initiating any trade. When operating on the 1-minute chart, the preferred approach is to look for an inversion fair value gap forming immediately after the liquidity sweep. Alternatively, when using the 5-minute chart, the focus shifts to identifying a breaker block, mitigation block, or inversion fair value gap that develops following the manipulation phase. Moving forward, when operating on the 1-minute time frame, the focus shifts to identifying a violated fair value gap that flips into an inversion fair value gap. This acts as our second layer of confirmation. Once the inversion fair value gap is formed, it often serves as a new resistance level, providing a strong zone for a potential sell entry. At the same time, if a market structure shift occurs, it adds further confluence and strengthens the overall setup. With these confirmations aligned, price is likely to retrace back into the inversion fair value gap, now functioning as resistance, before continuing lower toward the next sell-side liquidity pool. When it comes to executing entries using this model, there are two main options to consider. Before going into them, it is important to remember that additional confluences can always be incorporated, such as a V-shaped recovery or a change in the state of delivery. An inversion is a level changing sides, and traders rarely change sides with it. The buyers that gap rescued keep calling it support long after price closed through it, anchored to what it used to mean. Their defense is your entry. To break down the execution clearly, here is how I approach the entry. The first option is to enter immediately after the inversion fair value gap forms, by opening a position at the next candle open, placing the stop loss above the most recent swing high. The second option is to place a sell limit order at the lowest point of the newly formed inversion fair value gap and wait for price to retrace into the zone to trigger the entry. For take profit, several targets can be used. One approach is to aim for the nearest sell side liquidity on the 1-minute time frame, while a more extended target could be the Asian session midpoint or the Asian low. As an alternative method, a fixed risk to reward ratio, such as 2.5 or 3 R to R, can be applied, depending on your trading style. In situations where price has already started moving in the anticipated direction and the initial position is in profit, while there is still room for further downside, I often look for an additional continuation entry. This type of opportunity typically appears when price forms a new bearish fair value gap during a bullish pullback that follows a break of structure. In that scenario, the next unmitigated bearish fair value gap becomes the second entry zone, where another sell limit order can be placed, with the stop loss positioned a few pips above the most recent swing high. On the other hand, if the 5-minute chart is chosen as the entry time frame, the approach changes slightly. After the liquidity sweep and the higher time frame fair value gap delivery, the focus should be on identifying either a breaker block or a mitigation block. The live example ahead follows the 1-minute path, so treat these two structures as the slower version of the same read. For a valid bearish breaker block, price needs to form a swing high, followed by a swing low, and then a higher high. After this sequence, a strong bearish expansion must occur, breaking the structure and confirming the shift. In this situation, the down close candle or group of down close candles formed between the first swing high and the swing low defines the breaker block zone. From there, this zone becomes the area where the short position is planned. The next step is to place a sell limit order at the lowest point of that breaker block and wait for price to retrace into it. It is important to note that this differs from a mitigation block, since a mitigation block requires the formation of a lower high, rather than a high or a higher high. That higher high matters emotionally as much as structurally. It is the last moment the buyers were right, and where the most confident size went in. The expansion that follows turns conviction into trapped orders, and their exits make the retrace reliable. To define a valid bearish mitigation block, price must first form a swing high, then a swing low, followed by a lower high. After that sequence, we need to see a strong bearish displacement that breaks below the previous swing low. In this situation, the mitigation zone is identified as the last down close candle or group of down close candles formed between the first swing high and the swing low. From there, a sell limit order is placed at the lowest point of that mitigation block, with the stop loss positioned a few pips above the nearest swing high, while waiting for price to retrace back into the zone. In cases where the initial trade is already running in profit, it is possible to add another position as a continuation setup, especially if price forms a new bearish fair value gap during the following pullback. The name of this block is the psychology. Mitigation means someone escaping at close to break even, and relief is one of the strongest exits there is. Once that crowd is out, nothing is left holding price up. When that happens, the next unmitigated bearish fair value gap becomes the second entry zone. Before moving forward, it is important to go through a few key pro tips. In most cases, the higher time frame fair value gap forms after price makes a strong move during the previous day's session, or across multiple recent sessions. This setup can then repeat, staying valid on each new sweep of a previous session high for as long as that 15-minute fair value gap has not been fully filled. Once the fair value gap is completely mitigated, the setup begins to lose probability and is no longer as reliable. Letting that level go is harder than finding it. You marked it, you waited for it, and by the time it is fully mitigated, it feels like it owes you a trade. It does not. The edge was the imbalance. To bring everything together, let's move into real chart examples and walk through exactly how to apply this trading model, step by step. On the screen, we have the Euro-Dollar 15-minute chart. As observed, price created a large, unmitigated fair value gap during the Asian session, and it has remained unfilled for a period of time. If you look carefully, you will also notice that the New York session high is positioned just below that higher timeframe fair value gap. At this stage, all the required conditions for this setup are already in place. We have an unmitigated bearish higher timeframe fair value gap, along with a key buy-side liquidity level formed by the New York high sitting directly beneath it. This means the setup is fully aligned. From here, the next step is straightforward. We wait for price to sweep the New York high, tap into the higher timeframe fair value gap, and then reject back below the range. As the chart progresses, you can see that once London opens, price begins to push higher. After sweeping the New York high and tapping into the 15-minute fair value gap, price starts to show clear signs of rejection. At that point, I move into the 1-minute chart to closely monitor for reversal signals. Looking at the 1-minute chart, it becomes clear that after sweeping the liquidity above the New York high and delivering into the higher timeframe fair value gap, price quickly drops back inside the New York high range. At first glance, everything appears clean, but before entering a position, an entry model still needs to form. Observing closely, after the manipulation phase and the mitigation of the higher timeframe fair value gap, price begins to move lower and initially violates a large bullish fair value gap, flipping it into an inversion fair value gap. At the same time, additional confirmation appears as price closes below the bullish candles that led into the sweep, while also forming a market structure shift that confirms the move. Once the inversion fair value gap is established, it tends to act as a new resistance zone, providing a strong area for a potential sell entry. Following this, I enter a sell position at the open of the next candle immediately after the inversion fair value gap forms, placing the stop loss above the most recent swing high. For the take profit, the target is the nearest sell-side liquidity on the current time frame, which results in approximately a 2.5 R to R setup. Now, let's move the chart forward. As the price action unfolds, you can see that after a brief drawdown, price continues lower and eventually reaches the take profit level cleanly. That brief drawdown is where most correct trades get closed. A position that is right and temporarily red feels identical to one that is simply wrong, and only invalidation separates them. Your stop already answers that, so nothing else has to. To wrap up, notice that every element of this model points at the same thing: the liquidity sweep, the fair value gap, the inversion, the session window. None of them describe what price is doing. They describe what traders had to do and where they were forced to do it. That makes the chart a record of decisions, and your edge is being the one person in it who was not in a hurry. Stay patient, wait for full alignment, and execute only when every condition is met, because that is where real consistency and a real edge are built. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.